Okay, we're good.
All right. Well, here is June's edition of Extension Hot Topics, and I'm excited today because it's actually one about ag economics, which is more in my area. The rest come before have been horticulture, which has been Jeff's specialties, but we have Dr. Michael Langemeier here today, and I know ag econ is usually gets a boring bad rap, but it is not boring, is it, Dr. Langemeier?
Definitely not.
No, it is not. So Dr. Langemeier is Associate Director of the Center for Commercial Ag, and he does a lot of interesting research on farm input prices, custom rates. We have some really good data going back to the early 70s on the land prices in
Yes,
the
mid
US.
70s cash rents and land values.
So we get a lot of people that ask for that information all the time out in the counties. That research goes a long way for people. But I'll go ahead and just let Dr. Langemeier take over, and he's got some good stuff for you.
Okay, I'm going to share my screen. Courtney, let me know if you can see it. Okay, we tested this out, but you never know. Look okay?
Yep, looks great.
Okay, today I'm going to talk about crop net returns. And so this is going to focus more on corn and soybeans. So that's what we're going to try to address today. Let me try to get my window open as far as I can here. So let me just go ahead and get started with this. I've got several topics that I want to address today, and I'm going to try to touch on each one of these, even though we only have 45 to 60 minutes. And so I want to start with the Ag Economy Barometer, which is a producer sentiment index. That's one of the main topics that the Ag Economy Department Center for Commercial Agriculture is working on today. And so we get a lot of mileage from the farm press in terms of the sentiment for U.S. producers. And so I do want to highlight that a little bit. And then I want to talk a little bit about expected corn and soybean prices as we move into the fall and winter. And then I want to talk about net return projections and make sure I cover at the end of that net return projections, some projections related to cash rent and land values. As many of you know, land values have increased rather dramatically the last 2 or 3 years. And so I'll talk about where things might be heading here in the next year or two. So let's start with the Ag Economy Barometer. This Ag Economy Barometer is a producer sentiment index, and we started this monthly sentiment survey, which creates the index. We started this in late 2015, and it's going till today. I'm working right now this morning before this podcast or webinar. I was actually working on the June survey, looking at the June survey. And so this is a monthly survey of 400 U.S. agriculture producers focused on some of the primary crops in terms of value added in the United States. So heavy emphasis on corn and soybean producers, wheat producers, and also beef producers, but there's other producers in the survey. In terms of who we survey, this is a phone survey, and we're trying to target individuals that are full-time farmers. And so that's why we say value of farm production greater than $500,000. Just for a tidbit, for your information, about 90% of the farms in the United States are part-time farms, meaning that they farm, but they also have an off-farm job or considerable off-farm income. That's not really who we're targeting in this survey. We're targeting on people that make their living in agriculture, and so that's the focus of this survey. We do not survey the same people every month, but we try to keep the characteristics of the people every month. So every month we're trying to survey approximately 50% corn and soybean producers. So at the end of the survey, every month we have an open-ended question where people can share their thoughts. And lately, there's been a lot of sharing in terms of their thoughts. There's been a lot of things that are on their mind, and this word cloud kind of summarizes some of the things that they've told us in May. The June survey is still in process, and so progress, and so we won't get those results until early July. But you can see here some of the things that are very important to people. Inputs obviously are still very important. We'll talk about input costs later on. Also, prices in general, as I'm going to show you here, crop prices are expected to drop rather substantially from now until next winter. And so we'll take a look at that. Obviously, politics is also always on people's minds, but you can see inflation, policy, investors, labor, regulation, environment. There's just a lot of things on people's mind. This is a little bit unusual that there's this many words on the word cloud. Actually, sometimes there's only one or two words. So, for example, when COVID was rearing its ugly head in 2020, in 2021, there was basically one word: COVID-19. But now there's a lot of uncertainty out there, and so people have a lot of different things on their mind. If you look at the ag economy barometer itself, we can see that the index right now is relatively low compared to what it was in early 2021. This means that people are relatively pessimistic compared to what they were in early 21. The natural question is to ask why. Why are people more pessimistic today than they were in 21? Well, let's go back to 21 and try to remember what was going on. In 2021, we were starting to see relatively high crop prices compared to 2019 and 2020. So that created some optimism. But also in early 21, input costs had not increased yet. And so we were looking at some potential very high margins for 21 in the spring of 21. And so people were pretty optimistic about agriculture because of that. As 21 progressed and we moved into 22 and 23, we saw a lot more inflation, and we saw a rather large increase in input costs that is still with us today. And so because of that relatively large increase in input costs, people are not as optimistic right now as they were back in 21. So that's no big surprise, I don't think. Recently, the index has dropped rather sharply from about 123 to 104 here. And that's due to the fact that we're seeing some weakness in crop price futures. And so we're expecting some weakness in futures prices, creating a bit of a margin squeeze, particularly for crop producers as we look at the 23 crop. Obviously, the 23 crop has a long ways to go. There's a lot of weather issues. I realize that, but this is what people are thinking in terms of their sentiment today. The ag economy barometer is really based on 5 questions, and we have 2 sub-indices we can create from those 5 questions. 3 of the questions are related more to current conditions, so the current situation, and 2 of the questions are related to future expectations. So what I've done here is actually show you the 2 sub-indices, and they don't always follow one another. And the reason why this is important is this kind of gives us a gauge on what people are thinking today compared to what they may be thinking 5 years from now. The future expectation questions are really related to looking at 5 years from now. For example, one of the questions is in essence do you think agriculture is going to have good times or bad times in the next 5 years? That's an example of the future expectations question. And so it's looking forward. And you can see right now there's more weakness in sentiment with future expectations. And that's not surprising to me at all because 21 and 22, particularly for crop producers, were very good net farm income years. And so as we look at 23, 24, 25, it looks like net farm income is going to be down rather substantially compared to what it was in 21 and 22. And so that's why the index of future expectations is lower than the index of current conditions. One of the questions we always ask, at least we've asked the last several months, is a question related to their financial performance in the next 12 months compared to the past 12 months. And we're seeing more pessimism regarding 23 financial performance as we continue into 23. And again, that's not real surprising because we do expect there to be a bit of a margin squeeze this fall. When we look at crop prices and break-even prices, there's definitely lower margins potentially in 23 compared to 21 and 22, and that's showing up in this diagram right here. Now, remember, we're talking about a lot of different farm types here. Some of the farm types that are surveyed, for example, beef, has a pretty optimistic looks pretty optimistic for 23 and 24. And so you are going to have a fraction of the producers that things look better compared to what they were in 21 and 22. And so just keep that in mind when I'm discussing this, discussing the ag economy barometer. 2/3 of the producers are corn, soybean, or wheat, but there's also about 15 to 20%, depending on the month, are beef producers. And so beef is looking at some pretty good times right now, and that's reflected in this chart right here. One of the questions that I always take a close look at when I'm getting ready to talk to the press about the Ag Economy Barometer, as I indicated, the press is very interested in this to see what the sentiment is out in the countryside. Is one of the questions I always look at is this one right here. And so this is kind of a question related to what keeps me up at night. We phrase this exactly like I've got it worded here. Looking ahead to next year, what are your biggest concerns for your farming operation? And I call this the big three. Higher input costs have been there for probably 18 months now as being very important in people's minds, and it's still there. Even though inflation is somewhat lower than what it was the last year and a half, it's still relatively high compared to that long-term inflation rate of 2%. We're still looking at 4% inflation right now, and so higher input costs are on people's mind. And I'll talk more about that a little bit later here. Obviously, interest rates have increased rather dramatically. That's also a big concern of a lot of people, particularly if they have quite a bit of money borrowed on capital items such as machinery and land. That would be a big concern. And then also people are starting to realize that lower crop or livestock prices might also be impacting their net returns. And so that percentage that said lower crop and livestock prices is increased rather dramatically in the last 2 or 3 months. And I think that's pointing towards the lower sentiment that we're seeing, that we saw in May compared to what we saw in January, February, and March. Another question, we've got a lot of questions in the survey, close to 30. I'm just summarizing a couple of them that are related to our theme here today: input costs and net returns in crop agriculture in Indiana. Another one here is related to interest rates. Perhaps you heard yesterday that they paused the increase in interest rates. The Federal Reserve paused their increase yesterday or the day before. That doesn't mean they're not going to continue to increase, and that's what we've asked the producers right here in May. And so there's still a pretty substantial group of people here that think we're going to see anywhere from a 1 to 2% increase in interest rates as we move into 23. I would probably be in the 0 to 1% higher. I think we'll have a couple increases as the year proceeds because inflation is still 4%, which is quite a bit above their Fed's target of 2%. And so we'll probably see at least some small increases during the year, perhaps bringing up this prime interest rate to something closer to 9%. As a rule of thumb, in agriculture, you need to add a 1 to 2% to the prime interest rate to get the operating interest rate for agriculture. And so if the prime rate increases to 9%, that means you're looking at an operating interest rate for agriculture 10 to 11%. That's something we haven't seen for quite a while. It's been over a decade since we saw interest rates around 10%, but that's what we're looking at later in 23. And so obviously this is a concern for producers because most producers have at least some money borrowed, particularly full-time producers. And so what I want to do here is I want to pause and make sure, see if you have any questions related to the Ag Economy Barometer. Okay, I'm looking at the chat box right now, and so I'll look at these. you mentioned beef. Can you comment on pork forecast and financial performance for Indiana farmers? Yes, let me talk about the financial performance for Indiana farmers first. Net farm income is expected to be down sharply in 23 compared to 21 and 22. Like I said, 21 and 22 were banner years, and so we're moving closer to the long run average. I don't think 23 is going to be a train wreck, and primarily because we sold crops, the 22 crop in early 23. A lot of people held some of their crop to the early 23 and sold that at really good prices. And so that's going to help net farm income, because net farm income is accrual, and it'll account for selling the 22 crop in early 23. And so that's going to help net farm income. And so we're probably moving something that's closer to average, but it's still down sharply from 21 and 22. I do not follow the pork industry as close as I follow the corn, soybean, wheat, and beef industries, but I do know that the pork industry right now is really concerned about supplies, high supplies, and they're also concerned about feed costs. And so all I can point in terms of the pork is those two things are something that we need to take a close look at. Yeah, I'm just looking here. Got the website for the. Okay. Okay, so let's move on now. And so now I want to briefly talk about U.S. corn supply and demand and soybean supply and demand. And so let's start with corn. And there's just a couple things I want to highlight here. The corn balance sheet will not address weather issues until we get into July and August. And so if we continue to see dryness across the corn belt, the yields will be lowered in July or August. And it's really too early to start adjusting those yields, because usually July and August dictates what corn supply is going to look like in the fall. And so that's why the balance sheet right now is using trend yields. If we do have trend yields, we're looking at close to record corn production in this country. If we look at demand for corn, we primarily have demand from the feed industry. So we're looking at some very solid demand in the feed industry and also the ethanol industry. Those are the two big users of corn. And so the demand looks pretty strong in both of those industries. Certainly ethanol is up sharply from what it was a couple of years ago when we were dealing with COVID. And so that's a good sign. The exports are expected to be a little stronger in 23-24 compared to 22-23. So that's also a good sign. On the negative side, we're looking at a very sharp price decline, as you can see at the bottom of this slide. And that's because of the high production is causing a higher stocks to use. And so we have more corn in this country, which essentially weakens the corn price. If we look at corn yields, I thought you might find this interesting. I always find this interesting. It's truly impressive how much corn yields have increased in the last 50 years. This has been going on for a long time, and so this is nothing new. I'm just showing 93 here, but we've been increasing corn yields for decades at a pretty steady pace. Obviously, there's ups and downs here, but the trend yield this year is about 181 bushels per acre. That's for the United States. The trend yield for Indiana would be closer to 185. And in some counties, particularly northern Indiana, it would be above 190. And even a couple counties probably closer to 200. And so very impressive increases in corn yields over time. That's what the corn balance sheet is currently using, is trend yields. Again, they'll adjust these in July and August if they need to, based on weather conditions. If we look at where the corn goes, I thought you might also find this interesting. Feed by far and away is the largest use of corn, followed by ethanol. Sometimes these trade places, but rule of thumb is 35 to 40% of the crop goes to feed industry, 35 to 40% goes to ethanol. Exports represent 15, 16%, depending on the year. Even though the 15, 16% does not look like a very big share, because the United States is such a big corn producer, we're the largest corn exporter. Even though we only have 15% of our corn going overseas, we're still the largest corn exporter because we're such a large producer of corn. And so a lot of countries depend on US for their feed supply.
You have a question just about the China flooding the market with beef and other meats, cutting domestic producers. I didn't know if you wanted to touch on that before you got too far away from that.
I look at exports in a typical way that economists look at it, as exports are a good thing. And so the fact that we have demand for our crops and our meat products and our milk products, such as cheese, is a really good thing, because it allows us to increase production in this country and increase, and it also increases demand for our products, and so it raises the prices. And so so I don't think it's necessarily a negative thing that China is interested in our pork and our beef and poultry and on and on and on. I think that's a good sign, and particularly the beef. You have to realize that when it comes to beef, the United States is a very high-end product. And so countries like Japan and China, they do raise some beef. Obviously, Japan raises a high-end beef, but China not so high-end. Those countries are looking for a high-quality product like the United States provides, and so that's a very positive thing. And quite frankly, the livestock industry in my lifetime, I've been in this business now for over 30 years. When you look back 30 years, our exports of beef and pork were fairly tiny. Our industries have grown substantially during that 30 years. And right now, our industries depend on those exports. And so you'd have to shrink, in particular, our pork industry substantially if we did not have exports. The same is true of the beef industry. And I know that it's concerned with the beef industry because prices are really high in the grocery store. But all that is going to do, what that's going to do, the fact that prices are high right now, it's going to spur increased production, particularly in the Great Plains. They've been suffering with a lot of drought, and once that drought is diminishes somewhat, you're going to see a surge of beef production in the Great Plains, and some of that beef is going to end up in the export market. So hopefully that answers the question.
There's another about increases with difficulty getting fertilizer and sky-high prices with fertilizer.
Yes, fertilizer prices are still relatively high. I've got a chart in these slides. If I don't get to those, you can take a look at that. But fertilizer prices are still relatively high. That's the bad news. We're probably up still 50% over the 10-year average, and so that's substantial. But we have came down from the peaks we saw last year. So that's the good news. I think as we continue to work through some of the supply chain issues that we had coming out of COVID, I think you'll see fertilizer prices continue to drop. I don't think they're necessarily going to go to the 10-year average next year, but I think we'll see some decreases in fertilizer prices in the next 1 to 2 years. And so that's the good news. The bad news is we're still dealing with relatively high fertilizer costs this year. Yeah, and as you see questions, please ask them to me. So if we're looking at corn, we're by far and away the largest producer of corn. China's second, but China doesn't export any corn. In fact, they've imported some of U.S. corn in the last few years. And so China has such a large pork industry that they use all the corn they produce, plus buy corn from Brazil and the United States. And so we're by far and away the largest exporter of corn, followed by Brazil. We hear a lot about Brazil when it comes to soybeans, and they are a soybean powerhouse, if you will, and I'll show that here in a couple minutes. But they're a smaller player when it comes to world corn production shares. They export a lot of their corn to China and other places, but in terms of production, they're still only 1/3 as large as the United States. Looking at the monthly Indiana corn prices, I decided to take a long-term look at this, and so I've got it from the start of the ethanol boom in early 2007. We had this spike in prices in 11 and 12. Remember, the 12 was the very severe drought, so it caused some relatively high prices. And then we had some relatively tight stocks to use here in 21 and 22, driving those prices up. We're still relatively high here. The latest information here is from April. There's always a time lag in the USDA NASS prices. So the latest here is April, but we're looking at prices coming down as we move into the fall. If we have trend yields coming down closer to that long run average, which is 470. They probably won't hit the long run average. If you look at the December corn futures, we're looking at corn prices probably around 5 to 525 later this year, but certainly much lower than what we saw in early 23 and for most of 22. And so that's why there was a drop in the sentiment. People see those futures prices and see, oh, prices have really changed compared to what we've seen in the last couple of years. This is good news for livestock producers because feed costs have been very, very high. And so that's the way that typical works. Bad news for crop producers in terms of lower prices, but good news for livestock producers. Looking at soybean supply and demand, similar situation to corn. We're looking at very large production, still using trend yields in the May balance sheet, and probably will in the June balance sheet. We'll be looking at using the same trend yields in July and August. They may change that. But when you're looking at soybeans, there's two major uses of soybeans. One of those is the crush. Going into soybean meal, there's also a pretty healthy demand for soybean oil these days. Some of that's used for biodiesel. I can answer any questions related to that if you have any. That's a very positive development for soybean demand in the United States, is increase in soybean oil. It's also caused some vegetable oil increases in the grocery store, by the way, but very, very positive for soybean producers. And then the other major use of soybeans is exports, of course. Year in, year out, we export about half of the U.S. soybean production. If you look at China by itself over a long period of time, China buys about 1/3 of all U.S. soybean production and has that's kind of a long run average, a 15-year average. And so obviously they're a very important player in terms of buying our soybeans. You're also seeing an increase in stocks to use for soybeans. And so we're seeing a rather large drop in prices for soybeans, just like we saw for corn. Unfortunately, the break-even prices are not dropping. Part of it's that fertilizer is still relatively high, but we've got some relatively high costs also related to fuel repairs, specifically machinery costs are pretty high. Machinery investment prices for tractors and combines are relatively high, and so we're looking at some fairly strong break-even prices in 23, and so that's going to cause that margin squeeze for soybeans, just like we're seeing for corn. Soybean yields are also quite remarkable in terms of their growth over time, and they're just as strong as corn. Corn gets a lot of press for its increase in corn yields, but soybeans on a percentage basis is very similar to corn. Very strong increases in soybean yields over time. So a trend yield of about 52 for the United States. For Indiana, that would be closer to 56, 57, with again northern Indiana 60 or above in terms of trend soybean yields. As I indicated, the two main uses of soybeans are export markets. Export markets is below 50% right now, but that sometimes is 50% or higher. And then the crush. There's been pretty solid demand for in the feed industry, but also soybean oil for the crush market. Looking at soybean production, there's a couple things here that are really interesting to talk about. If you haven't seen this before, But even if you have, this has changed. This has changed rather dramatically, even in the last year or two. Brazil now produces almost 40% of all the soybeans in the world. That's truly amazing how much production has increased in Brazil in the last decade or 2 decades. So about 40% Brazil. The United States is 30%. We produce more today than we did 10 years ago, but our relative share is declining because Brazil is increasing production and we're holding production steady. And so that's why their relative share is growing. Argentina is about the same as it was 10 years ago at about 12%. So that's the first thing, how big a player Brazil is. And so when you talk about competition for soybean exports, you're talking Brazil and the United States primarily, but you're also talking Argentina because Argentina produces soybean meal and then ships that soybean meal to China and other places. And so Brazil and the United States, it's the soybeans themselves that are being shipped. And there is a reason why Argentina focuses on the soybean meal. It's primarily related to their tariffs, how the tariff taxes are calculated. Another thing that's very interesting about this chart, and this is very good news for the United States long term, is 80% of all soybeans in the world are produced by 3 countries, Brazil, Argentina, and the United States. I don't see that changing. I'm part of a national benchmarking group for corn, soybean, and wheat production that is based out of Germany. There's about 30 plus countries in this benchmarking group. We all submit data from our respective states and countries and look at break-even prices and crop prices in our different countries and contrast those. And quite frankly, once you get out of Brazil, Argentina, and the United States, the crop yields and the break-even prices are considerably higher. Soybeans are very, very particular in terms of what the weather is when they're setting pods. And there's not a lot of places in the world that are conducive to growing soybeans at the yields that we're able to do so in Brazil, Argentina, and the United States. I'm not an agronomist, but I've seen that by looking at that benchmarking data. And so places like Ukraine and Russia that have been increasing their wheat production and also becoming more important players for corn have really struggled in terms of increasing their soybean yields. And so that's why Ukraine, for example, focuses more on sunflowers than it does soybeans, because they're more competitive when it comes to growing sunflowers than they are in terms of growing soybeans. Russia's focused primarily on wheat, followed by corn and a relatively small player when it comes to soybeans. But I think it's for the same reason. It's difficult to get the type of yields that we're looking at in Brazil, Argentina, the United States outside of those 3 countries. One country that does have pretty good yields, or a couple countries, but they're fairly small countries, is Paraguay and Uruguay. They also have pretty strong yields. And so very important production area in South America. And then, of course, the United States is also a big player. Canada has been growing recently, but it hasn't been growing very fast. I think as we continue to see long run weather changes, I think we'll see more production of soybeans in Canada, in parts of Canada. Looking at monthly Indiana soybean prices, it's a similar story to corn. They're highly correlated, of course. We saw the run up in prices in 11, 12, continued into 13 for soybeans. Then we saw that stretch of where we saw 14 to 19, where soybeans were well below the long run average. And then we saw this recent climb in soybean prices on very tight stocks to use, both in the United States and the world. So prices shot up to encourage a supply. And so we saw soybeans jump above $16 for a while. They're still relatively high. As of April, they were above 14. Now they're getting below 14, but they're still relatively high. But just like corn, as we start looking at full harvest, we're looking at soybean prices that are dramatically lower than what we've seen early this year, something closer to $12. So I want to pause there to see if there's any questions. So Courtney, if you could take a look at the chat, see chat room, see if there's any questions.
I think we're good. We're
Okay, let's continue.
Hang on. We do have one. I am wondering, with the current increases in China's purchase of land in other countries, how does that input affect the way the statistics are reported? If exports are viewed as what is grown and exported from what country?
Yes, that's a very interesting question. For the United States, the foreign ownership of land is such a small percent that it wouldn't make any difference. When it comes to countries like parts of Africa, that's a different story altogether. And there is some African countries that have a pretty sizable, sizable investment in land from China. And that's certainly typically when you look at the export statistics, it would include exports regardless of who owns the land. And so certainly if you're looking at some of the countries in Central Africa, for example, some of those exports would be on ground that China owns. And we have to realize that China has such a big population, and China likes to be self-sufficient in as many products as possible. And so that's why they're looking at buying land in Africa and other places to try to be more self-sufficient in terms of feeding their population and feeding their animals. But in the United States and Europe and in South America, the percentage of foreign ownership would be small enough that it's really not impacting the statistics all that much. Looking at acreage, before we look at prices going into the fall, it's important to look at acreage. And I went back to 1990. This is kind of arbitrary, but that's when I actually started my career. So that's why I went back there. But I needed to go back before the 96 Farm Bill. Some of you probably remember farm bills going back quite a ways, and I'm certainly in that category. I've been, like I said, I started in 1990. The 96 Farm Bill was a major change in government policy in the United States. Prior to 96, the government payments were heavily tied to what you planted. And so, for example, if you planted wheat, you got a payment because you planted wheat. And so the calculations were based on planted acreage. The 96 Farm Bill changed that. They created what we call base acres, and so you received your payment based on what you used to plant, what you historically planted, but you got the payment regardless of what you planted. And so if you had wheat base in 96, 97, you could plant corn and soybeans. For example. And so that was the start of the decline in wheat production that we saw in the United States. It's substantial. We used to have 70 million acres of wheat. Now we're down below 50 million acres of wheat. In some years, it's as low as 45 million acres of wheat. And so that's one of the things that's happening long term. The other thing that happened that's very, very important when you look at this chart, well, there's two things. One is China entered the World Trade Organization in 2001, 2002, someplace in there. And so right away, the demand for soybeans shot up. And so we were seeing a rather large increase in demand for soybeans, which continues till this day. Because China has such a large appetite for soybeans. And so that was also a very important development. The other thing that happened, and it's very obvious looking at this chart, is you see the large spike in corn prices or corn acreage and prices in 2007. That was the start of the ethanol boom. We had ethanol before that, but we really weren't geared up to use a very large percent of the corn crop until 2006, 2007. And so in 2007, the signals were there to grow more corn, to supply the ethanol industry. And so the United States did that. And so we went from essentially 80 million acres of corn to 90 million acres of corn overnight. And so it really has. We really haven't looked back since then. And so if you look at the export market and the large demand from for feed related to corn and soybean meal, and then you also look at the ethanol industry. We need about 90 million acres of corn for domestic production and to meet our export demand. When you look at soybeans, we also need 85 to 90 million acres of soybeans to meet our crush industry needs and to meet the export markets. And so essentially what's happened here is corn and soybean have had higher demand than wheat. Both in the United States and worldwide. And so we're devoting more of our acreage to corn and soybeans. I think it's going to be difficult to go over 180 million acres of corn and soybeans in the future, because we still have quite a bit of demand for wheat in the United States for the food industry. And so the wheat in the United States is somewhat unique in terms of its quality characteristics. Compared to wheat that would be grown elsewhere and shipped into the United States. And so there's still a pretty strong demand for wheat. It's just not a strong enough demand to get 70 million acres, but there's a strong enough demand to keep that 40 to 45 million acres of wheat. And so one of the things that's happening, as I indicated earlier, is we're seeing an potential increase in soybean demand from biodiesel. And if that it is realized, if we see that continue to grow, we're going to need more soybeans in the United States, and soybeans are going to have to compete with both corn and wheat for acres. And so by definition, that's going to be positive for the prices of all three. And so that's why I say that's a very interesting development. And we're looking at that very carefully to see where that demand goes. But certainly if that increases as fast as some people in the industry think it might, we're going to see some pretty strong prices because of that for all three of these commodities. And so that's going to keep that price for corn up in that $5 range, rather than going back to something like $3 that we saw before 2007. Even if ethanol demand is weakened a little bit, we've still got a pretty strong demand coming from the soybean side. Looking at futures prices, these are futures prices. You'd have to adjust for basis if you wanted to take a look at you wanted to take a look at the cash price. And so we're looking at from a cash standpoint, if you look at that 50%, which is kind of the mid-range price here, you're looking at corn right around 515, 520. Cash price, soybeans right around $12, $11.90, $12. And so that's what you're looking at compared to the prices where we've seen recently. Corn was well above $6 and soybeans were well above $14. And so a pretty large drop in expected prices in 23. That answers your financial performance question. Input costs have stayed relatively high. We still have some very high break evens for corn and soybeans in particular, but also for wheat. And when you see lower prices like this, that just automatically tells you that we're expecting lower margins. The percentiles here mean that this is based on a iFarm price distribution tool, which gives us a distribution of prices based on currently traded option prices. What these percentages mean is there's a 25% chance that corn could be below 477. That would be 450 cash. That would be a big ouch. There's also a 25% chance that soybeans would be 11.22, which would be below $11 from a cash standpoint. That also would be a big ouch. That's well below the break-even price. That's a scenario where we get some rains here, and we have a large U.S. crop, and also other countries have large supplies. And so that's only 25% chance because that may not happen. There's also a chance that we could run into some weather issues with corn and soybeans in the United States and outside the United States. Remember, soybeans, there's only 3 countries that produce soybeans. And so if there's a weather scare in any of those countries, it impacts soybean prices. But there's essentially a 25% chance that corn could be above $6. That would be right at about $6, slightly below from a cash standpoint, and right at about $13 from a cash standpoint for soybeans. And so a lot of variability in soybeans depending on what the weather does, both in the United States and around the world. We're in a world market. Okay, there's a couple things I'd like to talk about, and these slides are, I don't know if Courtney sent these out yet, but we certainly can make these available to everybody. You can also get these slides directly from me. Rather than continuing here, I'm going to just talk in general about net returns and also cash rents and land values, and then open it up for any final questions you might have. And so if you combine the fact that input costs are still relatively high, inflation is lower right now than it was, but it's still 4%, and we're still seeing a 4% increase in input prices year to year. And so that's after a 15% increase in input prices in 22. And so the point is input prices increased in 21, they 22, they continue to increase in 23. That causes some high input costs. We have lower fertilizer prices, but all the other inputs seem to be continuing to go up, particularly repairs and machinery costs. Everything related to machinery investment. And so that's causing some pretty high break evens. I was talking about $5 corn as being a strong possibility this fall. Break even price, even on the high productivity ground in Indiana, is closer to $5.50. If you go to more of the average productivity land, it's more like $5.75. And so you can see the margins there are very tight. For this year's crop compared to what they were in 21 and 22, where we had prices well above the break evens. We have the same scenario for soybeans. Not quite as negative for soybeans. Actually, soybeans appear like they're going to be more profitable than corn this year, but that could change depending on the weather and the relative prices. But a similar story for soybeans. We've got break-even prices that are above the expected prices, and so how does that impact the cash rent and land value market? Well, cash rent is going to continue to go up in 23. We won't know what the 23 cash rent values were until we finish the survey. The survey is being conducted right now, and we'll publish those results in late July, early August. I'm expecting about a 5% increase in cash rents from 22 to 23 based on the strong net returns in 21 and 22. And so you always look a year or two back, and that's your indicator of what cash rents are going to do in the current year. So because strong net returns in 21 and 22, we're looking at some pretty strong cash rents in 23. Moving forward into 24, I really can't see a scenario right now where we're going to see a continued increase in cash rents. I think they're going to be more flat. Depending on how low the net returns go, they could be slightly down even. But I don't expect a crash in cash rent values going into 24, and I don't expect large increases at relatively stable values. Looking at land values are impacted primarily by cash rent or net returns and interest rates. Net returns are lower, interest rates are higher. That gives you a scenario where land prices are probably going to stabilize. And so after year to year or back to back, 20% plus increases in land values in Indiana, 23 is looking at land prices that are much closer to zero. I still think we've got some residual coming from the strong net returns in 21 and 22. So we might see a slight increase in 23 in the survey. But it's not going to be 20%. And then moving into 24, I think land values are going to be flat to slightly down, again, because of the lower net returns and the higher interest rates. And so certainly a different environment for net returns in the next 1 to 2 years, and also a different environment for cash rents and land values. But I want to emphasize we're not necessarily expecting it to be really ugly. I'm really expecting the returns and the cash rents and land values to be similar to conditions what we saw in 2020. And so maybe taking some of the wind out of the sails when it comes to land values. I would think that perhaps there might be a question or two related to cash rents and land values. And so I will pause here and wait for some questions.
Yeah, I guess this is Jeff, Dr. Langemeier. I guess if we were looking up, and I, as an extension educator, I can usually find the numbers, but if someone was doing their own work for cash rent, what would be the best resource as a starting point? A lot of people call me and say, what should I charge for my land? And I say, well, honestly, that's up to the landowner and the agreements, but what's a good starting point for that?
Well, first of all, every August, it's published in the Purdue Agriculture Economic Report. Every August, we publish the survey results for that year. And so in 23, for 23 land values, we'll publish the cash rent and land values in the August Purdue Ag Econ report. Now, those are average value, just average values. And so you can look at those average values. But what I tell people is when you're looking at that table, for cash rents and land values, take a look at the associated yield, particularly cash rents. What was the corn yield associated with that cash rent in your area and productivity level? So for example, I'm in West Central Indiana, and I'm looking at and I want to look at average productivity land, which would be pretty good land in West Central Indiana, but average for West Central Indiana, I think the yield was 190 bushel. That's what the person answering the survey said is associated with that average productivity land in West Central Indiana. And so what I tell people, how does your yield compare to 190? If it's a little lower than 190, look at the cash rent per bushel and use that figure along with your yield to calculate a cash rent. And so don't just use the cash rent value. Take a look at that cash rent per bushel of corn and use that along with your corn yield to look at cash rent. Now, you're always looking at cash rent a year behind. And so if I was negotiating 24 cash rent, you could use that 23 cash rent per bushel along with your corn yield, your average corn yield, to calculate a cash rent, and then you need to adjust it for any changes you might be seeing in 24. Based on my discussion today, I think you could use the 23 cash rent, because I don't think 24 cash rent is going to be any higher than 23. We're not looking at an increase in 24. And so does that make sense, Jeff?
Yes, it does. That helps out tremendously. Thank you. Courtney, I did not see anything else in the chat box. I don't know if you had gotten any messages.
No, nothing else. I just was going to throw in there a little plug for our succession planning team. Michael, he works with us in extension on succession planning, which is farmers and how they plan to turn the farm over to the next generation. If anybody is a farmer out there or knows farmers and needs a plan, I know my family's in the middle of that right now. And a lot of times you don't even think about it until somebody wants to retire, but you don't have to wait that long. So Dr. Langemeier helps with that. And I heard you come up with a number for if a family member wants to come back to the farm and join in, what it takes monetarily to bring that somebody back in.
Yes, a minimum would be $500,000 gross per person. That would include all hired labor too. That would be kind of a minimum value to generate enough family living, to bring that person back. And so, in many cases, when you're thinking about bringing somebody back, you need to do something different. You need to expand. But expansion doesn't necessarily need to be renting additional land or buying additional land. You can also think about an expansion as trying to increase the value per acre. And so that's where growing things like popcorn, waxy corn. We've got a farm on the farm tour. We got a farm tour this year in Washington County. Both of those farms have added value per acre to bring folks back. One of the farms, the younger family member built a laying hen barn for cage-free laying hens. And combining that with the acreage they have, he was able to come back to the farm. Another family has increased their produce part of the business. They've grown watermelons and cantaloupe and honeydew for a lot of years, but they've increased that part of the business to try to add value per acre so they could bring somebody back. But that's always a challenge, is to think about, how can we bring this person back if we're not big enough right now? In many cases, if the farm isn't large enough, because it hasn't had to be. I mean, we didn't have enough workers to be any bigger than we currently are, and so you need to think about expansion, which can be adding value per acre, but also adding acres. And just a plug for the transition planning: it's never too early to start. Don't wait till the family member is 80 years old and wants to quit. Start much earlier than that. And the other big thing to think about is communication. I think it's very important to be transparent If the older generation has some very specific plans that they're thinking about, talk to the family members about that. It's still your decision and how you do it, but have that discussion with the younger family members and just say, this is what we're thinking about doing. What are your thoughts? And so on. And so start the process earlier and communicate your plan.
Mhm. Well, then the next thing I wanted to throw out there too is the farm management tour, which you kind of talked about. That's going to come up again the fall.
July 11th.
Oh, summer. Okay.
July 11th in Washington County.
Okay. And what do you do there? What happens at the farm management tour?
You can register on the Center for Commercial Agriculture website, but what we're going to do is we're going to spend 2 hours with each of these farms, talking about their current operation. One of the things that I always do is I always talk to each family member. There's multiple families involved in both of these farms. I talk to each family member and talk about what is their role in the business. What are they responsible for? And so we'll discuss that. We'll also discuss expansion. How did these people decide to expand in what they did expand in? Laying hens in one case and increasing melons in the other. How did they come up? How did they decide to do those things? And so we're going to have a pretty in-depth discussions related to that. Also, one of the farms that has the laying hens is also grows a lot of cover crops. And so that'll be a very interesting discussion for him to talk about his experience growing cover crops. This year was a bit challenging growing cover crops, but there's been other challenging years too. He'll talk a lot about that. In addition, that same person is growing popcorn. So you can also talk about how did they get involved in popcorn production, why they just decided to grow popcorn rather than commercial corn. And so there's a lot of interesting discussions I think we're going to have on both of these farms. They've got a lot of things going on, including bringing family members back to the business.
Cool. All right. Well, thank you so much for coming on today with us, Dr. Langemeier. We really appreciate it. And we will see you next month.
And then yep. Thanks, Dr. Langemeier. And then for those of you who are still on, next month, we'll be starting season 2 of our Extension Hot Topics. We appreciate everyone who's watched this on YouTube, who's been with us live. So we're going to start season 2 is what we're calling it. That'll be July 20th. We have Marguerite Bolt scheduled. She is our hemp production specialist on campus. She has a lot of good information. The hemp market has kind of had some highs and lows in the past few years. So she's a really great resource because there are some small farmers who are looking to get into that business, and Purdue does a really good job of being very concise and clear on, where the futures can be. So she'll have some information on that. And other than that, I think we're good to go. But yeah, we appreciate you coming on. I do think that part of this Extension Hot Topics is to understand that, there are many parts of farming and economics. If you're not thinking about it, you're usually behind you're usually in the red. So we appreciate you coming on, Dr. Langemeier, and getting all that stuff out there for us. And then we'll get this stuff posted. And thanks everyone for joining us. I'm going to stop recording now. There. Okay.